Hello, dear viewers. My name is Arvin Nanda, and today I will present the findings of my thesis titled Indonesia's Market Reactions to the Announcement of OJK Regulation Number 14 of 2023 on carbon trading. I conducted this research under the supervision of Professor Jugianto. Let us begin with the introduction first to provide context for this research. As you may know, climate change poses a severe global challenge to ecosystems, human health, and economic stability. As part of the Paris Agreement, Indonesia aims to reduce emissions by 29% by 2030 and achieve net zero by 2060. These ambitious goals require significant policy shifts to address the challenges of carbon emissions. Despite all of those commitments, 82% of Indonesia's energy is still derived from the fossil fuels. And this heavy dependence creates critical challenges related to Scope 1, Scope 2, and Scope 3 emissions. Addressing these emissions requires targeted policies and sustainable transitions. To address these challenges, OJK introduced carbon trading to the Indonesian market, formalized through OJK Regulation Number 14 of 2023. And this diagram shows the preceding regulations. And these regulations formalize Indonesia's carbon exchange to meet emission targets, but it introduced potential abatement costs and more uncertainties, impacting mainly the financial sector, which is regulated under UU P2SK, and carbon-intensive sectors, which is regulated under the Permen LHK number 21 of 2022. My research seeks to answer three key questions. Did the Indonesian stock market, especially financial sector and carbon-intensive sectors, react to the announcement of OJK Regulation number 14 of 2023? And these questions aim to identify the broader economic implications of the policy. Now, let us move on to the theory and hypothesis development. This study is based on the efficient market hypothesis, which stated that the stock prices fully reflect all publicly available information. And there are three forms of this hypothesis: weak, semi-strong, and strong. The event study methodology is used to test the semi-strong form by analyzing how specific events impact stock prices within a defined time frame. Other relevant theories for this research are information asymmetry, where one party in a transaction possesses significantly more or better information than the other, and signaling theory, which explains how entities convey quality or intentions to reduce uncertainty and attract favorable responses. The emission trading system, or ETS, is a market-based mechanism designed to reduce greenhouse gas emissions. The framework was first introduced through UU HPP 2021 and served as a foundation for carbon trading initiatives in Indonesia. This carbon trading system, as formalized by OJK Regulation Number 14 of 2023, is heavily supervised and regulated by OJK. A comprehensive review of literature on sustainability event studies, emission trading systems, and OJK regulation event studies suggests that such regulations often influence market reactions. So, this indicates that the OJK regulation on carbon trading might affect the market reaction. Based on the literature and theoretical framework, the regulation signals increase in abatement costs, which potentially decrease investors' wealth and might show significant negative market reaction. Thus, the first hypothesis of this research is the announcement of this OJK regulation affects market reaction negatively. And given the financial sector's heavy involvement in the carbon trading scheme, the announcement of this OJK regulation might also affect the Indonesian financial sector negatively, which become the second hypothesis of this research. And this OJK regulation introduces a carbon pricing mechanisms, which increase abatement costs for all companies involved, especially for carbon-intensive sectors, which might experience skyrocketing additional costs for compliance. Thus, the third hypothesis of this research is that the announcement of OJK regulation affects the Indonesian carbon-intensive sector negatively. We can continue to the methodology of this research. To ensure a robust analysis, I used a purposive sampling method. The initial sample consisted of 880 Indonesian stocks listed on the IDX. Stocks with the confounding events, such as dividend changes, IPOs, or stock splits, were excluded to avoid bias. After this process, a final sample of 558 stocks was selected. Then, the sample was categorized into three primary groups. First one is all stocks. It includes all 558 stocks across various sectors. And then there's the financial sector for the hypothesis 2 and carbon-intensive sectors for the hypothesis 3. The data was gathered from the estimation period of 120 days before the event and the event window, which spans T-3 to T+3 relative to the announcement date. Historical stock price data was collected from Yahoo Finance using its Python API integrated with the Jupyter Notebook. To measure the stock market reaction, I calculated the cumulative abnormal return, or CAR, for all three groups, starting from calculating the realized return from the price data, then calculate the expected return using market model. After that, calculate the abnormal return from the realized and expected return. Finally, the cumulative abnormal return, or CAR, can be calculated. After that, perform the statistical analysis. First of all, analyze the normality of each data using Kolmogorov-Smirnov method, and then perform the hypothesis significance testing. If the data is normally distributed, then we can use parametric testing, and if not, use the non-parametric testing with Wilcoxon sign rank test. Let's begin with the results and discussion. So this section summarizes the data analysis, hypothesis testing, and how the findings address the research objectives. Here, the descriptive statistics show that the mean and median values for all groups were negative, indicating a decline in stock returns. The sharpest declines occurred at T0, the announcement day, and T+1, 1 day after the event. This trend reflects immediate investor concerns. Also, there was a decline for T-1 as well. It implies there was an information leakage about this regulation to some investors. This is proven when we plot the CAR. It reveals consistent negative trends across the three groups. The normality test results indicate that data for all stocks, financial sector, and carbon-intensive sectors were not normally distributed. Thus, we applied non-parametric tests, specifically the Wilcoxon sign rank test, for reliable statistical analysis. For the hypothesis testing, two approaches were employed. The one sample Wilcoxon sign rank test to assess significance within the event window, and the Wilcoxon sign rank test for paired differences to compare the CAR before and after the event. These methods ensure robust and accuracy evaluations of market reactions. The all stocks groups showed a significant negative CAR, with the steepest decline on T0, or the day of the event, at minus 0.0115%. 152. This reflects market concerns over abatement costs and uncertainties tied to the regulation. The financial sector recorded the largest negative CAAR, with a peak decline on T0 at minus 0.0204. This underscores investor concerns about regulatory burdens and the sector's central role in carbon credit management. The carbon-intensive sectors experienced significant negative CAARs as well, with the largest decline also on T0 at minus 0.0143. This highlights the financial strain of the high abatement costs and compliance pressures in emission-heavy industries. So, in summary, all groups exhibited a significant negative TAARs, driven by the concerns over compliance costs and the operational uncertainties. With the financial sector saw the steepest decline, followed by the carbon-intensive sectors. So we are arriving at the final chapter of my thesis. And to conclude, this chapter summarizes the key findings, the implications, and the limitations of this study. Here are the conclusions from this research. So the announcement of OJK Regulation Number 14 of 2023 on carbon trading triggered a negative market reaction, with a declining cumulative average abnormal return reflecting investor concerns over abatement costs and uncertainties. The financial sector showed the stronger negative reactions than the broader markets due to regulatory burdens and adaptation challenges to carbon trading. And carbon-intensive sectors faced negative sentiment as high abatement costs and carbon credit requirements hurt stock prices. This study provides important takeaways for academia, policymakers, and also businesses. This study shows how carbon trading announcements impact stock returns, focusing on regulatory effects in carbon-intensive sectors and guiding future research for academia. And policymakers should communicate clearly and face regulations to reduce market uncertainty. Businesses must adapt with clean technologies and transparency to stabilize stocks. While this study serves its purpose within its research scopes, there are still several limitations. First, it doesn't account for delayed responses or long-term impacts. The second, the public stock data may not fully reflect the financial health of the firms. Future studies could include financial statements or qualitative data from the open companies to even the private companies. And lastly, the findings are specific to Indonesia and may not apply to other markets. The future comparative studies across different countries are recommended to assess global implications of every carbon trading policies. So, this research underscores the critical interplay between the OJK Regulation Number 14 of 2023 and the Indonesian market reactions. And thank you for watching. Have a good day.